and welcome to this week's episode of Nucleus Investment Insights. The question for discussion today is, will rising interest rates crush house prices? On the agenda, we'll examine property macroeconomics, how property is valued, then we'll delve into the potential effects of rising interest rates, then we'll look at Nucleus Wealth's in-depth property calculator and play around with some scenarios of buying versus renting and investing in property versus shares. And of course, as always, we'll cover the investment implications at the end. My name's Sam Kerr, and I'm a Senior Financial Advisor at Nucleus Wealth. And today we'll be joined by none other than Damien Klassen, the Chief Investment Officer at Nucleus Wealth. Damien, great to have you here as always.
Thanks, Sam.
So this is, I guess, a topic on many people's minds. So it's going to be good to explore the issue with some scenarios and a few facts. Just a quick reminder before we get started. If you enjoy our content, please subscribe to our YouTube channel and click the bell below to be notified when we go live or have a new episode recorded. Alternatively, follow us on your preferred podcast platform. Our show's available on all the majors. And for those of you listening live today, feel free to drop your questions in the YouTube live stream chat, and we'll do our best to answer them during the show. So now that we've got that little bit of housekeeping out of the way, we'll get into it. So, Damien, I'll hand it over to you to get us started.
Yeah, sure. And I guess I'll start by saying, I'll take the question mark out of that sentence. Is that rising rates will crush Australian house prices. It's just a question, and so what it really for me is about is, which is why we've got this calculator, is sort of showing this interaction you get between how much people pay for their rents, how much people are earning as wages, and what that does relative to the cost of a mortgage, and how that sort of helps determine the prices of houses within Australia. And then what that means then is, if interest rates are going to go up, and I've got a chart there showing the monetary policy expectations, sort of the priced in at the market at the moment. If they go up by what is priced in by markets, then you're talking about 7% interest rates, and I don't think the Aussie market can handle 7% interest rates. It's just going to crush Australian house. Something's got to give at that point. And so I guess what it is, that's a question then from the investment side that we'll get to later, which is about saying, well, what is it? What is going to give? Is it either going to be that yes, the RBA does need to raise to 7% interest rates and mortgage rates, 7% mortgage rates, and that's going to crush house prices and the flow on? Or is it that rents are just going to boom, and rents and wages are going to boom, and they're going to grow at 10% per annum, and that'll allow the RBA to raise rates at that speed? Or is it that that they just won't be able to raise at that speed? And I guess where I'm getting to is one of those needs to give. So so this chart up here, basically this is what's priced into the market. The yellow line is the RBA, and so you can see we're behind everyone else. So the Fed has already lifted off. Same in Bank of England. In New Zealand they've lifted off as well. Europe's looking like lifting off, but not going as far as what we are in Australia, as what is forecast at the moment. But you can see Australia ends up sort of far, and eventually catches up and overtakes them by next year. By this time next year, we're sort of looking at having the highest rates around, which is not to say that. Sorry, this isn't my forecast. This is what's priced in by the market at the moment, which is which we think is a little bit fanciful given the structure of the Australian market, sort of, and the amount of debt. Like, Australian households have more debt than any other country in the world except one. And so the effect of those interest rates rises are going to hit harder. So that's one part. That's probably our key short-term driver for house prices. I've got a number of other short-term house price drivers that I've sort of shown this chart a few times. Is that these demand factors and supply factors. And what I'm looking at here is just, from 2012 to 2017, we went through this big boom, and basically all the factors were headed in the same direction. The price of your credit was price of credit was cheap and actually getting cheaper. There's lots of credit available. Employment was pretty good. Population was growing. Foreign buyers, and so we've had this. We put on this boom in terms of everything headed in the one direction. We went to bust in 2018 when credit basically dried up. Pre the pre the Royal Commission, as banks sort of pulled back with the expectation that they had been lending irresponsibly and they were going to get in trouble for it. They certainly got in trouble via the Royal Commission, but that actually, none of that actually flowed through into government policy, and arguably the government policy's largely been the opposite to what was what was there. And so that's meant that house prices have been back off and running again. So going forward from here, post COVID, we've really had lots of credit available. It's been anything you wanted was there. The price of credit was as low as it's ever been. Employment was been pretty good. But going forward from here, the question is, will that price of credit turn into a negative? And quite possibly. Population growth has been really bad, but will that turn around? Foreign buyers, again, sort of, I think there's the view certainly from China is about capital controls and certainly not wanting to do any favors for Australia. So we're expecting foreign buyers will probably still be quite muted. Tax incentives, we're going to see, we've seen already a number of tax incentives for new home buyers, and don't doubt throughout the election campaign there'll be more sort of things thrown to try and help either new home buyers or developers. Money laundering, there's Australia's been called out on a number of occasions, the Australian housing market for being a bit of a hotbed for money laundering, and it's been, I think, 15 odd years since it was mooted that houses and the whole housing industry should fall under the same anti-money laundering as say shares or banking or other investments, and they've managed to avoid it. It keeps getting pushed off for another year, and so that's still going strong. And then supply factors, we've got this restrictive planning. Yeah, it's a little bit restrictive, but there's a number of rules out there. But probably the bigger issue is the under and over supply. And I've sort of said that's a bit of an each way bet, depending upon how you want to deal with it. There's certainly lots of supply coming on, but the question is it in the right places? And we've got a lot of apartments that are still being finished up. And there's obviously people sort of move away from that. So I've got this short-term picture that looks a little bit unclear. The longer-term picture looks a bit clearer in my view when you start looking at some of the measures, and that's what we've got that's what we've designed this property calculator to do, is to give people the feeling of can we of how do you price property in the longer term. So within it, we've sort of hit, or the ones we sort of hit upon and sort of try and focus the attention on is 4 different measures in order of importance. The first one is the mortgage payments to rent. So the idea is if you can rent somewhere for $1,000 a week, then or you can buy the same place and pay a mortgage of $750, then people are going to be keener to do that than if you can rent somewhere for $1,000 a week and it's going to cost $2,000 in mortgage payments a week to buy into that. So that's one constraint. The next constraint is mortgage payments to wages. There's a certain limit to once you reach. Well, theoretically, they talk about being 30 to 40% of housing stress in terms of versus wages. But at the higher that gets, if people have to start putting 50 or 60% of their income away just to afford the mortgage payments, then that's obviously a constraint as well that we've got. So and there are 2 key ones that we sort of drive these models from. And it's really an affordability model. It's basically saying that the investment side of it, which is sort of the rental yield or the ability to save for a deposit, is a little bit to the side. It's a little bit less important, because the net effect is certainly the way house prices have been for the last 20 odd years is it's more about if people can afford it, then they'll pay up for that. And it is a lifestyle product, and also there's a very strong view amongst a large number of people that housing is a very safe asset and it can't go down, and so therefore that sort of leads them to, if they can afford it, they will buy it. And so that's what we base this model on. So that's I will get into the model in a minute, just to sort of show what some of the ratios have been doing in the past quarter or two. It is also worth talking about the housing market in terms of I've called it the stock versus flow. And the idea with this is that the housing market is very, very big, and it doesn't take much change in terms of some of the ratios within it to free up a lot of dwellings. So what I mean by that is every year Australia builds somewhere between 100 and 200,000 dwellings for whether that's knockdowns and rebuilds or brand new dwellings. And so there's opening up these a lot of it is new, so we're opening up extra houses. Australia has about 11 million houses out there, and 11% of those are unoccupied. So what does that mean? That means there's about 2.6 people per occupied dwelling. So if you want to free up some more houses in the short term, so officially the number is 2.64%, and in terms of the number of people per dwelling, if you change that to 2.55, so we're basically changing the second decimal place. Our overall number doesn't even change. We're still at 2.6. We've just gone from 2.64 to 2.55. That'll free up about 350,000 extra new dwellings, just because there's the number of houses, 11 million houses, is very, very big. You don't have to change that ratios by very much. And so that just means, a few more kids moving out a little bit earlier, a few more people saying, oh, I'll have one less flatmate, a few more divorces. It doesn't make that much difference to really, absorb a lot of new dwellings, or go the other way, adding an extra flatmate, people staying at home for a little bit longer, and then all of a sudden the demand for dwellings is not that great. The other one you could do, if you want to get another 150,000 new dwellings, you could change the unoccupied rate. The unoccupied rate's 10.5%. Change that to 11.4. Again, in that third decimal place this time. It's still 11% unoccupied, but we do that, and that frees up, or that absorbs like another 150,000 new dwellings. So where I'm leading to this is, yes, in the long term, it absolutely matters how many houses are being built every year. But from a year-to-year basis, the number of houses that are being built, pales in insignificance versus the change in some of these ratios about, how many people per household, or how many unoccupied houses are there in terms of people, with holiday homes or second homes or even Airbnbs and things like that, sort of, effectively are a dwelling that's somebody's not living in full time, so it's effectively an unoccupied in terms of the it's not housing somebody, not housing somebody on a full time basis. So leading into that, sorry, does that all make sense, Sam? Is there anything I need to?
Yeah, that's all making sense. We've just got a couple of comments coming through. So one says, if the market's correct and rates rise by 3.5%, then average mortgage repayments would surge by about 48%. And they're saying there's no way the RBA will lift rates that far. What's your take on that?
Yeah. Oh, look, I think that's right, and I guess it's that point. I sort of do my numbers on the median household, and you look at what they could have borrowed at. If you're and we just use Sydney houses because that's it's a nice easy one, and it's probably more, and it is the most extreme market. But if you bought the average Sydney house last year, got yourself a 2% interest rate, or close to 2% interest rate, and you put down 20% deposit, you'd be paying about 50 grand a year in interest plus repayments on that. If we go to 7%, you'll be paying closer to 100 grand. So it's actually pretty much a doubling in terms of that. I mean, yeah, you might be able to extend the term out to 40 years, or there might be some other things you can do, but basically on the same mortgage, it's a massive increase. And I guess that's what my overall point is. Something's got to give in this equation, and we'll show you, as we go through this calculator. You can't have everything. You can't have, if you say house prices aren't going to change, or they're only going to fall by 10%, then what it means is that the price people will be paying for houses will still be something like double the you'll be paying a mortgage, and your mortgage will be double the cost of renting that same place. And so so we'll move that. We'll sort of get into that in a minute. Is there any other ones?
That's it at the moment. All I can see, but I'm sure they'll come through as we progress.
Yeah. Yep. So yeah, so if we look at the latest stats, so if we look at the mortgage payments versus rent, and so with all these, it's based on, I basically take the lower of the 3-year interest rate, the three-year fixed rate, and the discounted standard variable rate that's on offer to the banks, on offer from banks. And so at Sydney, if you do that comparison, you're talking about 173%. So basically, if you want to get a mortgage, you're paying 73% more than renting the place. In Melbourne, it's 162. So they're the sort of biggest markets. You can see the other ones down there. You know, if you go somewhere like, say, Perth units, for the cost of your mortgage would be 80% of the cost of renting the same place. So yeah, if you're renting a place for say $1,000 a week, then your mortgage will cost you $800 a week. Whereas in Sydney, if you're renting something for $1,000 a week, your mortgage is going to cost you $1,730 a week. So that's where they are at the moment. The mortgage payment versus the average full-time wage. So again, this is on the median property versus the average full-time wage. Is that in Sydney it's 80% of it goes into a house. So basically, if you want a house there and you're getting started, you pretty much need to. Well, not pretty much. This is the average full-time wage before tax. So you absolutely need 2 people, and you probably if you want the median house, you need to be on higher than the average wage. So that's those figures, which sort of on their own, I guess are of interest. But what's more interesting is where they've been over time. And so the next one sort of shows the 3-month change in those valuation ratios. And so for all of them, they're getting worse, except for Sydney on a mortgage payment to rent, and basically because skyrocketing rents have have actually brought that back. So it's not an affordability positive, I guess, in terms of that. Is that if the only reason why your affordability improving for houses is because rents are looking worse, isn't sort of a great indication of why to buy. The one that I find, I guess, most telling is this third one. And so what I'm doing here is I'm just putting things on a percentile. So I'm saying if you're at 100, it's basically as expensive as it's ever been. And if you're at 1%, you're as cheap as it's ever been. And then just looking at over the last 40 odd years, where have these ratios been? So you can see that, like, we haven't even had an official rate rise yet. There's definitely been increase in mortgage rates, but we haven't actually had an official rate rise yet. And the mortgage payment to full-time wage in Sydney is already at a record high. It's almost there at Melbourne. Brisbane and Adelaide aren't that far off. From a mortgage payment to rent, they're pretty close as well. They're in the sort of, they're in the top 10% in terms of Sydney and Melbourne. If you look at units, it looks a lot better on the unit side. And Perth houses are basically about average as to where they've been sort of over time. So still not that So it's very different depending upon where you look. The other thing is, if you look at on the investment side, so I've broken this up into 2 parts. The left-hand side is the affordability part, and then the right-hand side is the investment part. You've got this extreme difference where on one side, gross rental yields are basically as low as they've ever been in most houses, and on units in Sydney and Melbourne as well. But if you compare them to the cost of interest, the interest rate, they're not as bad. They're sort of sorry, it's actually almost as good as it's ever been. You're in the sort of the bottom 10%. So it's this argument that what you really need is leverage, and the RBA spoke about saying it wanted to keep interest rates low for an extended period of time, and so encourage people to get out and buy, and people have got it out and buy, and now they're not keeping interest rates for an extended period of time. So that obviously will get worse as interest rates rise, but you still have that extraordinary difference between those two. So then I want to look more at the macro background. So I've got some of the mortgage rates here. You can see that jump in the mortgage rates. Again, I've got these graphs. The way you read these ones, I've got them up. Is the one on the left is the line chart on the left is the last 40 years, and the bar chart on the right is a histogram, sort of shows you what percentile is it at the moment. So you can sort of see that mortgage rates are at almost as low as they've ever been, but certainly they've jumped up quite considerably from where they were over the last 2 years. Inflation's also jumped, so that's your other key one that we'll get into in a minute, and then we have wage growth. So and I've done a 3-year wage growth just because the 1 year is very noisy and hard to tell what's going on, and so you don't really see the some of the improvements we've seen in wages in recent times. But I guess the message is pretty clear though. Average 3-year average real wage growth has been very, very low, and even nominal has been well below 5% for some time. And then we have the rental growth, and there has been a big jump in rents. And the question is, is that something sustainable, or is that a frictional issue of not enough houses in the right places as people sort of change their view, their needs due to the pandemic? There's a reasonable chance that household formation is going to be relatively high. Coronavirus did cause a lot of divorces. Did mean that I think there's a lot of people who are now working from home. I know there's a lot of people working from home a number of days a week that didn't used to, and so I think for a lot of people there's going to be that'll create a desire for bigger houses or to move out of an apartment into a house or have more space, and so that's quite potentially we'll see that household formation or have one fewer flatmate or move some kids out of their room and use that room as a study. There'll be a push for, I think, for greater household formation, but that'll sort of depending upon economic conditions. So
So Damien, what do you mean by household formation? Do you mind just explaining that a bit more?
Oh, okay, yeah. So I spoke about there being 11 million houses in Australia. Is that you then have to try and work out, well, how many, with a 30 or close to 30 million population, how many people per household, and what grows that is when older kids move out of their parents' house. That sort of grows the number of households, because it goes from having one household to now 2 households, and that's an economic imperative. Usually, is that if the child either can't get work or can't get work at a high enough wage in order to pay for their own rent, then they stay at home, and you don't get this new household, and it's almost it's a sort of latent desire for that to happen, but until economic conditions sort of improve to the point where that child can move out and pay rent, or you have people, there's share flat, there's 3 people living in a shared flat together. Some of them would prefer there only to be 2 so that they can have a spare room for the study or something like that. And then so if that happens, somebody else moves out to form a new house, and you get sort of a bigger number of houses within that. And that's the key driver, I think, in end to house prices. But what we're positing, and that's what we've sort of built this model to show, is that that's an economic imperative rather than as much as it is a sociological one. So there's a desire for people to move and have more space and live with fewer people, but if they can't afford it, they won't. And so that's where we sort of driven this model, and why we do a lot of the comparisons of mortgages compared to rents and mortgages compared to wages.
Okay, great. And there's been some questions around the vacancy in properties as well. You said around 11%. What's the main sort of makeup of that?
Yeah. Okay. That 11% is very different to the vacancy rate that you get in terms of rental properties, because what that includes is say in Airbnbs, so the holiday houses. So you can't that can't absorb a new household. So if my son wants to move out and form his own and start living by himself, an Airbnb, well, it's a very expensive way of doing it. I guess theoretically they'd rent it out on a day-to-day basis, but he's got to look for somewhere that's actually leasing a property that he can lease out on a 6 or 12 month basis. Airbnbs aren't aren't that. So they sort of don't sit in that category. There's properties people own where they own two places and they just don't want to rent it out. Whether they, it's a house, it's an apartment in the city and a house in the country, and they sometimes use each of them, and it's literally just not rented out. So they sort of, you've got one household, you've got to pick one of those, and the other one's considered vacant. And so, so that 11% is a broader one. The amount of properties that are actually available for lease, and then how many of those are empty, is very, very low. So that's what they're talking about in terms of the vacancy rate of, so I guess it's a subtle but important difference, a difference between a vacancy rate, which is there is a house available to be rented, versus the unoccupied rate, which is, well, how many houses just don't have people in there for whatever reason.
Okay, great, thanks. There's lots of discussion in the comments there, so that's good. But should we move on to the specific markets?
Specific markets, yeah. So I'll pick a couple of markets, and then we'll get onto the calculator and sort of show some of these, how it works. One I wanted to pick on in particular was Brisbane. So Brisbane has been a very affordable market, and actually, and you go back a year on both houses and units, it looked quite affordable. That's been Brisbane houses has been the fastest decline in that. So you can see that line on the mortgage payment to median wage has basically gone vertical. The mortgage payment to rent has done the same, and the property price to median wage has also sort of skyrocketed. And just to put that in perspective, so what that means is that if you look at so if we're looking at Brisbane, and we're saying the 45% of the median, if you bought the median property on the median wage, that would cost you 45% of your wage, your pre-tax wage. So whereas you go back a year and it was under 30%. The mortgage payment to rent, you can see that, and this is, each market's a bit different, and that's why, say if you're interested in a particular market, jump onto our website and have a look at, it's got each market broken out. But you can see here that Brisbane houses sort of go somewhere between about 80%. So the mortgage payments is somewhere between about 80% and sort of peaks out at about, well, over 150%. I think once you get above maybe even 140, once you get above 140, that seems to be about the limit for Brisbane. And so currently at 117, and again, stressing, this is with no official rate rises yet. Whereas if you flip across to the units in Brisbane, they actually still look all right. So the mortgage payment to median wage is still only 19%. It's at the 7th percentile. So almost as cheap as it's ever been. And relative to rents, it's a little bit cheap relative to rents. It's at the 29th percentile. So in the bottom third of cheapness. So basically, you get a mortgage is going to cost you 80% of what your mortgage payments are going to cost you 80% of what your rental payments are going to be, which looks sort of roughly in line with sort of the longer term averages, but it certainly has been far higher and far lower at certain points. So Brisbane, dichotomy between the two markets. The other one I wanted to highlight is the most expensive and the least expensive. Sydney houses to Perth units. So and you can see on these ones that Sydney houses, the mortgage payment to median wage has never been worse than what it is today. And this is, again, stress that point. We haven't even seen an official rate rise yet, and it's already as bad as it's ever been. Mortgage payments to rents. So basically, you want to get a mortgage on the median house, you're going to be paying about 70% more than the cost of renting that on a monthly basis. So whereas you flick to Perth, and those numbers are pretty low. Your mortgage payment to rent in Perth is, you're getting sort of 20%. Your mortgage is going to be 20% cheaper, and you're only paying 18%. So it's close to as low as a proportion of wages as you've seen. So there's that. So I'll jump down to the calculator. So you can get this. You can jump onto nucleuswealth.com, and there's under the resources, there's a calculator, property calculator, and we're going to run through a live example of that. But I just wanted to, I guess, look at some of the ratios that you can get out of here, just for the purposes of showing, I guess, to show a little bit more quickly than going through the calculator. So I've got we do a live one. We can go live if you like. Sam?
Yeah, the calculator's up there, so you just
Yeah.
guide me
So
through.
let's go. So we've got hopefully you can see on scene. So we'll go with $1 million. So cheap Sydney house, so well below the median price, $1 million. And let's say you've got $200,000 down as a deposit, and then and you can see what that automatically does as well is you can see the rental numbers. We have like a we have what that means on an annual rent basis. If we're just using the average numbers for the market, you can change the rental if you want, but showing the average numbers for the market and what that is on a weekly and a monthly basis. So then if you jump to the next screen, you then choose what type of economic environment. Now we can play around with these figures later. These are just sort of pre-canned ones. Let's just pick moderate growth and take it from there. And then we go to the now we look at how we're going to forecast this. So I'll go with the mortgage cost to rent, and let's just have that as we'll just leave it as what it is now. So basically saying the mortgage cost to rent is going to stay the same, as we sort of put in these economic changes. And then we sort of go through to the next screen, which will show us what that means for what does that actually mean for the property over time. Now, there's a slight delay on. I'm going to load this up in my background as well because there's a slight delay in YouTube, so I can't actually see Sam's screen live. I hadn't thought about that. So cost to rent, and so we can see on that under that the property basically makes you after 10 years you get 30 grand out of that. Actually, sorry. Let's go down and change some of these economic assumptions first. So we're going to adjust the assumptions to improve our forecast. Let's click on that one. Now let's make, let's say you think inflation is going to be running hot. So what we're going to do is we're going to design something that's going to be running red hot for the property market. So we're going to give it a 3% inflation. We're going to say average wage growth is going to be great. It's going to be, so this is a real. So we basically, what that means is on a nominal basis, we'll add it to the inflation. So we're going to say it's 3%. We'll do 1% average wage growth. We're going to say the rent's going to grow by 2% real, which is 5% because we've already got 3% inflation. So we're going to grow at 5% rent, and then we're going to leave the mortgage at 4%. So we've basically designed a cracking market for property, and we look at that and we say, yes, great. We're going to make 300,000. If this is what we're expecting, that the economy is booming and mortgage rates don't rise, then we're going to put $200,000 down. We're going to make 279 grand over 10 years. You can see on the right all the where that comes from. So how much of that's rent, how much of that's your property costs and interest costs, and then you change in the value of property. So that's what we're looking at now. Now I'm just going to go. Let's just give that 7% mortgage rates. So we go back down and change it to 7%. And keeping in mind that the reason why this is going to fall now is because we've said that the mortgage rate, the cost of rent versus the mortgage is going to stay the same. So it's going to be 70% greater for Sydney houses to get a mortgage than what it is to get rent. And so and we've got booming rents. We've got rents growing at 5% per annum for the next 10 years. So rent's going to be almost double by the end of that 10-year period as to what they are today. So if you look at that at 7% interest rates, you're going to lose. Everything else is great, but interest rates have gone up to what's priced in. You're going to lose almost 400 grand on that property. The property itself is actually going to go up in value over that time. So the net, if you can see a grey line there of property if there's no debt. What's going to kill you is the interest expense and the fact that you're it's mostly the interest expense on that one. So that's one way of doing it. The other one then is just to show you that mortgage payment to rent. So if you scroll down, you can see the mortgage payment to rent is set to 172. If we then scroll that back to its 10-year average of about 150, so basically that if you want to, that your mortgage payment would be 50% more than the equivalent rent, is you can then and hit the recalculate button again. is you can
Sorry,
see
Damien, where are we looking here? Mortgage payment to rent.
you need to be on the adjust assumptions to improve your forecast,
Yes.
and then down on there's a property assumptions per annum, and that chart on the left.
Mortgage payment to rent. Yeah, and what would you like that at?
I think I've got it's let's call it 150. So it was at 170 now. So we're basically saying it's going back to its 10-year average. And then under that scenario, you can see now that now the price of the property is starting to fall, and now the losses are much larger under that scenario. So I guess what I'm trying to say here is we've given this great environment where inflation's going up, property rents are doubling over 10 years, and all these other great events, and you're still finding it very hard to come up with a buy case for property, and it all comes down to that interest rate. And so you flip side it, and we've got wages growing at much higher rates. I'll let people go and play with it themselves, and if all you have to do is pull your inflation back to more normal levels, put wage growth back down to a more normal level, and rental growth back to rents generally go at inflation or below over the longer term. So if you bring that all back, and all of a sudden there looks like some quite large losses you can get out of property over that time period. Without even needing to be too bearish in terms of the what the ratios are doing. I'll highlight as well a few other things you can do on the calculator. One is you can compare renting to buying. There's a little calculator in the middle of that screen. The idea with this is it's an opportunity cost argument. So what you want to do is say, well, if I've got my deposit, what am I going to do with that? What am I going to do with that money? So, sorry, did you hit the calculator in the middle there, Sam?
Yeah. Yes, we're on the rent assumptions.
And then you need to then say, what's the after-tax return if you invested somewhere else? And so, and the reason why I'm saying after-tax is because you will pay tax on this money. So you take so in the scenario we're looking at, you take your 200 grand, and rather than buying a property with it, you say, okay, I'm just going to rent instead. Where do I put that 200 grand? Let's say I put it into shares or something, and I earned a 2% after-tax return, or let's pick whatever number you think is reasonable for that, and then go to the next one, and that'll show you your sort of net gain for renting versus buying. And it's probably less interesting on this one because look, the scenario we had was showing we already know that the property is going backwards, but we do have the cumulative cash flow example as well as just what's your difference in cash going out the door, and then what's your capital gain and capital loss scenarios where you're looking at a property where you make money from it, and then saying, okay, well, usually what you'll find is for the first few years you're better off renting rather than buying because your transaction costs kill you, but then eventually buying sort of takes the lead on good scenarios. On this scenario, it just never gets to the stage where you're in front. And keep in mind as well, this scenario, we've got rents growing, we've got rents doubling over the next 10 years. We're growing at 5% per annum on a nominal basis. So we've been, in terms of rent, we've been pretty pretty harsh in terms of that. And the other one you can do is do a comparison with shares as well, which I might leave that one, but basically it's a similar type of calculation. You go and say what do you think the price to earnings ratio will be, and we show you an historical average. You can then let's do it. I'll do it quickly. Well, not take long. So we said we go to the Australian and we can see the forward PE is 17 times at the moment. Let's say we said that was going to go back to 15 times, which is its long-term average. What's the earnings growth of shares going to be? We've said 3%. What are you paying on your shares in terms of annual fees and entry costs and everything like that? And then hit the next button, and that'll show you, how much you make from shares versus how much you make from property, depending upon those scenarios. So that's all there. I might throw that back then to you, Sam, for maybe hit up a few questions before we?
Yeah, okay. I'll have a bit of a scroll. There's lots of comments about people not really believing that the interest rates are going to go up that much. You know, considering how the mortgage stress already a lot of people.
Yeah, and you know, all those figures we're showing, you know, is that interest rates have already risen by considerably. They've already gone. You haven't noticed it because it was in the 3-year fixed rates, and so what it means is that new people coming into the market, rather than getting a 2 point low an interest rate in the low twos, now they're getting an interest rate in the high threes, and so that's slowed that part. What we haven't seen yet, though, is, and you won't see for a number of years still, is the people who did borrow at 2% or 2.1%, and then they roll off their 3-year mortgage, and it's like, happy days, now you're paying 4. So that's and that's just today, let alone once if we get another, as market's pricing in another 3% interest rates, you could conceive the way the market's pricing it at the moment, you're basically saying that these people who got in on a 3-year rate at 2% are going to roll out of that and suddenly face 7%, and that's and the Australian economy will handle that. So which we think is fanciful.
Yeah, and there's a bit of discussion around approximately 1/3 of people own their houses outright, and this is gonna affect people that have bought their houses in the last few years the most, because they're probably going to have the higher interest costs and higher debts as well. And what effect do you think that's going to have on the economy?
Yeah, absolutely. So well, that's I might move into that into the in the investment implications. So I might go maybe to the viewer question of the week then first. That's gonna.
Sure thing. This is now we've got our viewer question of the week. Obviously, this is for viewers to have some discussion in the comments section over the coming days. So the question for this week is, which will give interest rates or house prices? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. And Damien, now I'll hand it back to you for the investment implications.
Yeah. So I've got that, as I said, the 3 different elements. You've either got to get really great rental growth to sort of justify the valuations of house prices as interest rates rise, or wages growth. So really good rental growth and wages growth to mean that people can actually afford, the interest rates, higher interest rates. Or you've got to have, or interest rates can't rise as far as what they're priced in at the moment, or house prices are going to crash. You got to pick one of those 3. And so if you don't believe the interest rates, then the investment, is buying bonds, government bonds, or and the fixed term bonds, and buying international stocks with a view that, look, if interest rates don't push up as far as what is priced in, then it's quite probably going to be Aussie dollar negative, and so that's your international stocks are going to help to offset your holdings there. If you believe interest rates are going to 3.25%, then you're not buying bonds. You'd probably be short bonds. You're definitely selling anything to do with housing, whether it be banks, any of the housing building materials and things like REA Group and things like that. You want to be clearing yourself of that housing market, and you will probably want to be hedging your international holdings. If Aussie interest rates can go can add another 3.25% from here, then that's going to be Aussie dollar bullish. And so, if you've got any international, you want to be hedging that because the Aussie dollar's headed up if that's your view. Our view is that, look, the thing that's going to give is house prices, and once house prices start giving, then the interest rates they'll stop raising interest rates. The Australian economy is the Australian consumers are just far too indebted to be able to handle significant interest rate rises. I completely get it that a third of people don't have any mortgage, and those people are going to be, often will be retirees, and they're going to be winning from higher interest rates on their cash. But the house prices really get done at the margin, and it's the part about you won't get new household formation because kids won't be moving out of their parents' house because they just literally cannot afford even 5 or 6% interest rates, given where house prices are today. It's very difficult to see how that would work. And people who have, there's going to be a delayed effect, as I said before, of the people who got a mortgage rate at 2% and then they roll it off and they've doubled, or pretty close to doubled even at today. Let alone the people, if we see another 1 or 2% stuck on, and now you're talking about tripling your interest rate, that's just going to smash demand, which is and the effects will flow right through the economy in terms of that. You're talking, I would say at 7%, we're talking about a recession for Australian economy, and quite a deep one. So so my take is, what's going to give? Look, I think it's going to be interest rates are not going to go anywhere near what what's priced in at the moment, and so we're more on the buy bonds, buy international. Certainly, the Ukraine war has been a push for Aussie stocks and commodities in particular. But again, our take is that that's a relatively short term. There's some short term structural issues that need to be sorted out, but when you look at the longer term effect of that, the Ukraine is the 57th largest economy in the world, and Russia's the 11th. You can take from a global perspective and ignoring humanitarian issues, you can take the entire Ukraine economy out and its exports, and the world will work through that in terms of the economic impact. It's not going to be that great. Short term, yes, big changes, but the longer term effect is not that much.
Okay, excellent. Thanks for that, Damien. So that almost wraps us up. I just want to thank you for sharing your knowledge and insights as always, Damien. I'm sure lots of people are going to get lots of great info out of that.
Thanks, Sam.
So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it into the YouTube comments below or send us an email at contact@nucleuswealth.com. Just a reminder, this is general advice and does not take into account your personal situation. If you do want to discuss your personal financial situation, please go to our website at nucleuswealth.com and book a call with me or one of the team. Don't forget to like the video now. And finally, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you can please share it with them. Also, if you'd like to see more of our previous episodes and content, head over to nucleuswealth.com/content. And to stay up to date with news from us, you can also follow us on all social media. So from myself, Damien, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.